Most people think trading is about luck, but in reality, it's a mix of math, emotion, and timing. If you've ever wondered what really happens when you buy or sell crypto, let's break it down simply. What is trading? Trading means exchanging one asset for another, usually aiming to profit from price differences. In crypto, that means buying coins when they're cheap and selling when they rise. Simple idea, hard execution. The exchange, where it happens. Every trade happens on an exchange, a digital marketplace that matches buyers and sellers. There are two main types: CEX, centralized exchanges like Binance or Coinbase; DEX, decentralized ones like Uniswap, where trades happen peer-to-peer. The order book. Behind every price you see is something called an order book, a list of buy and sell offers. Buyers set bids, sellers set asks. When they meet, a trade happens, and that's the new price. Market versus limit orders. When you trade, you can choose how to buy or sell. Market order, you take the best price right now. Limit order, you set your own price and wait for it to hit. Traders use both speed versus control. Crypto versus stock market. What's the difference? If you've traded stocks before, crypto will feel familiar, but faster and wilder. Both have buyers, sellers, charts, and order books. But the differences matter. Crypto runs 24/7. Stocks close daily. No central exchange. Thousands of crypto markets, not one NYSE. Volatility is way higher. And ownership? You can move crypto instantly. You can't transfer Apple shares to a friend at midnight. Why crypto moves faster? Stock markets move with earnings and news. Crypto moves with attention and belief. When a story spreads, prices can change in minutes, not days. That speed is both opportunity and danger. Spot versus futures trading. Spot trading is simple. You buy real crypto. Futures trading is a bet on price. No real coins, just contracts predicting up or down. More leverage, more risk. The role of liquidity. Good markets need liquidity, lots of buyers and sellers. More liquidity equals smoother trading and fairer prices. Low liquidity means big swings and higher risk. The chart everyone stares at. Charts visualize all those trades. Each candle shows price movement. Green means up, red means down. Charts don't predict the future, but they reveal behavior, where people buy, sell, or panic. Emotions in trading. The hardest part of trading isn't the math, it's the mind. Fear, greed, FOMO, they all show up in charts. That's why trading psychology matters more than any indicator. How to start safely. If you're new, start small. Practice on demo accounts. Learn how exchanges work and understand risk before chasing returns. Remember, it's a skill, not a gamble. Let's recap. Trading means buying and selling crypto through exchanges. CEX or DEX both match orders between people. Charts show history, not destiny. And mindset makes the difference. Subscribe to learn why. Next up, trading psychology, why 90% fail.